Welcome to the Investment Banking Leaders Podcast, brought to you by the Investment Banking Leaders Club, your exclusive access to the industry's most successful leaders. These experts have closed thousands of deals, generating hundreds of billions of dollars, and they're here to share their strategies, insights, and leadership lessons that can fast-track your career. But the learning doesn't stop here. Join the Investment Banking Leaders Club at ibleadersclub.com for even more exclusive insights, leadership frameworks, and career-accelerating resources and events. Thanks for joining us, and best of luck on your growth journey. Today's guest is someone who's operated at the very top of global investment banking for decades now. From Salomon Brothers to Lehman Brothers, through the crisis and integration into Barclays, to co-leading Cowen and playing a key role in its acquisition by TD Securities, Larry Wieseneck has seen, led and shaped investment banking across multiple cycles. Today, as head of corporate and investment banking at TD Securities, he sits at the center of one of the most compelling growth stories in global banking right now. Backed by one of the largest balance sheets in North America and significant white space for expansion across products, clients, and markets, it's a really exciting time for him and the team. Now, having got to know Larry, what's fascinating about his journey is not just the institutions, but the range. He's built a career across analytics, capital markets, strategy, leadership, among many other areas. And along the way, he's developed a clear viewpoint, really, on why most producers fail as leaders, what truly differentiates great organizations, and how to build a career that compounds over decades. So Larry, I'm super excited about this conversation. Welcome to the Investment Banking Leaders Podcast, and thanks for joining us.
Thanks for having me. I have to admit, when you were describing some of my background, I was thinking you must have been talking about somebody else. But thank you for those very kind words.
And a podcast host on your own as well with Viewpoint. So
yes, indeed. Yeah, so we enjoy that. We've been doing it now for about 4 or 5 years, maybe longer. I think we started it really during COVID as a way to deal with some of the themes in what we call strategic finance, which is the intersection of capital markets and corporate strategy. And it's been really fun to do. So.
Well, I know it's been a really great initiative, so congrats on that. And great to have another podcast expert with me today. Hey, you didn't start in traditional investment banking, if you will. You started in financial consulting and analytical work. Looking back, how important was that foundation in shaping how you think differently from traditional bankers?
First, I'd say definitely came in through a different route. I think it was fantastic. The first 5 years of my career, I worked in ostensibly the part of the consulting industry that worked with corporations that were building their strategic plans and valuing them and trying to make decisions as to whether they should buy a business, sell a business, or just invest in their business and grow it. And it exposed me to a lot of different industries. And so at a very young age, I got to see themes that were consistent across different industries, but also the differences. And what that allowed me to do is that when I did come into the investment banking arena, I was able to look across and see similarities. And it made it just much easier for me as my career expanded to go from working, say, with a financial institution to working with a defense manufacturer to then maybe helping out a consumer products company. And so it was a great foundation.
Yeah, I can understand why that variety would really help shape you and shape your experiences to come. And I know when we spoke, one of the things I found fascinating was how you explained convertibles and capital markets as the ultimate training ground. I know at Salomon Brothers, you were one of the few non-PhDs in a highly technical environment, but you shared with me your strength was translating complexity into something that clients really understood. And I loved that. And so how critical is that skill, is storytelling over raw intelligence in building a successful banking career?
You're actually bringing together a number of elements of some of the, I guess, things that I feel that I've learned over time. It's always hard to say I've learned because someone might disagree and say, well, actually, you learned all the wrong things. But from my perspective, one of the things that I think is just true about our industry, and I'd argue it's true about almost every industry when you get to the top of your game. Right. And if you think about in the business of investment banking, right, there are a handful of firms that operate at a very high level and have an opportunity to work at a number of them. Everyone who gets drawn in and gets hired into these organizations has raw acumen, right? They tend to be very bright. They tend to be very motivated because it requires both motivation and intelligence just to get through the screening process of you got to go to the right universities, you got to do well there, you've got to then interview well, et cetera. So you're dealing with a very high level of folks. The difference in terms of those who are able to really produce and build careers, and I'd argue by definition, therefore, do better than their peers, right? Do better than the averages, that they have to really enjoy what they're doing, meaning that actually, it's great to say I have the acumen, but do you enjoy it? And then how are you able to motivate others to do which is required to finish the job, right? When you're dealing in the client facing, that means motivate the client to either agree with your view, to maybe disagree with you and have a debate, and then that teases out information, and then execute for them. And that skill set is a communication skill set. There are some jobs, they're certainly not in what we would think of as the investment banking services world, i.e. delivering investment banking services to clients, but there's jobs in principal trading, there's jobs on trading floors, there's certainly infrastructure roles where you may not have to be as communication forward, and it may not be as important to motivate others. Certainly, there'll be other important skills there. But when dealing with client-facing roles, that ability to take the complex, to understand the complex, and explain it then to the client is critical. And I think that that's something that I've just seen in many different places. I happened to get exposed to it at a young age. And it was something that allowed me to move up, I think, more quickly than I would have otherwise. And that really came from my consulting background. So you mentioned earlier, the first 5 years in consulting, where I was thrown in the deep end because we were a growing firm, young firm, and I had to often explain complex things to folks 20 years my senior, and certainly much more senior in their organizations than I was, really set me up well for being a young investment banker, as you said, in analytical spaces.
Thanks for sharing. Yeah, engagement, enjoyment in what you do, and having those communication skills. And I can understand why really being able to tell the story enables the motivation that's required to get the deals done, both internally and externally. So it makes a lot of sense.
And I think importantly, Peter, to your point, and understanding the context, right? And so many times we'll see folks who are trying to explain a phenomenon, whatever it might be, and they put it in their own language, their language. I think a big part of being successful in our industry is having enough EQ to appreciate what the client's perspective is and making it something that they can understand. And it doesn't mean dumbing it down. I've heard people talk about that's not the issue. It's recognizing if someone comes from a background in, say, treasury, they'll have a different perspective than someone that was a line manager along the way up. If someone else was in fact, grew up in business development, right? All three might be looking at an M&A opportunity, but the way they're going to analyze it's different. And you as an advisor need to be in a position to be able to speak to them in their voices to help them understand it.
Yeah, really put yourself in their shoes, understand the angle they're coming from. And I guess
it's empathy. I think great bankers and great salesmen, if we're thinking about it from the sales and trading side, they understand and have empathy so that they can understand where the client's coming from.
Yeah, I couldn't agree more with that. Really understanding where they're coming from, as you say. And I guess that context is only going to become more and more important with all the data now available and the impact of AI. So yeah, I can see why it's such an important skill. And you shared with me previously that a convertible bond background is one of the best foundations for future leaders in banking. Why is that?
One of the reasons is because my background's in convertible bonds.
You're biased.
No, but it's an interesting comment, and it's something I've reflected on recently, but it was a thought I had literally 30 years ago when I was a very young professional and had the opportunity to first do work on the analytics side of convertibles and then lead the convertible origination effort at Lehman Brothers on the way to other things. And the reason I feel so strongly about it is that it really is the one product that touches almost every part of an investment bank, right? If you think of it from the standpoint of what is a convertible bond, right? First, you have a credit instrument, which is the underpinning. And so if you're doing convertibles, you get exposed to both the high yield business, leverage finance business, and the investment grade business. You have to understand both because one day you might be working on a investment grade convert. The next day you're dealing with a non-rated or lowly rated name. Okay, so that's part. Secondly, the upside is equities. So you have to understand everything from the cash equities business, how research works because the research analysts get involved. You have to understand how the equity floor works in cash equities. But the form in which the equity exposure is embedded is via a derivative. It's an embedded call option, right? So now you're getting exposed to volatility. And so you're learning about the derivatives business as well. So in one area, the convertible origination area, you're getting exposed to literally 80% of what makes up a markets business, what makes up the traded assets, right, in the market. Now, you don't get exposed to ABS, et cetera. But again, what you do get is a structured mind. And once you've learned structuring and you understand how to make the accounting, the tax, the legal, and the market side come together, which is the job of a convertible originator, now you actually can look at other structured products as well. So I think it gave me and some of my peers across the street that were doing similar roles back in the 90s. And again, when we were doing this, convertibles were exploding. The proliferation of new products across the board were exploding. And so it put those individuals in a spot where they were at the forefront of where revenue production was going on the street. And it certainly set me up very well to take on other roles down the road, ultimately running equity capital markets, then running all of capital markets back at Lehman and then at Barclays, and then ultimately being able to run investment banking and corporate investment banking as my career evolved. But it did so for many others as well. And so I think that's the key on that front. So
it's interesting because I've had a lot of leaders I've spoken to that talk about variety and building your knowledge set and your knowledge base out. And that's really what you've explained by getting all these pieces of the jigsaw in place. So I can understand why it made you more competent, more knowledgeable, and obviously better able to make the transition.
And Pete, I'll just add one other thing. It's not just that. I probably focused on the hard side of it, meaning the tangible. The intangible was it meant that at a young age, people like me and again, and I say young, I should explain. Today, you might look around and see people that lead convertible origination desks, and they might be senior MDs and they're in their 40s or 50s. Back in the early 90s, when people like myself and others came of age in these seats, the street was just younger. We were growing faster. And so I was running convertible origination in the corporate equity derivatives business at Lehman when I was, I guess, looking back, 31 years old, right? And so what it exposed me to was the network of the leaders of the other businesses. So it wasn't just that I learned the products. I got exposed to the leadership of high yield, the leadership of investment grade debt, right? And DCM. I got exposed to the folks that ran the convertible sales and trading desk, heads of research, right? So it was that element as well, because I think to be successful, you need both the raw skill, knowledge, wisdom, but also relationships, because delivering the firm is about delivering everything, right? And you being able to get your phone call returned and having influence. So it was that as well.
Yeah, I can see how that network and ability to grow the network with influential leaders at that point must have been so useful. So thanks for adding that bit on as well. I want to talk a little bit about, I guess, the career inflection point, particularly from producer to leader. That's something we really focus on in this club and focus on helping aspiring leaders make that transition. So one of the most powerful points I think you made to me is that many top producers believe the next step is to become a manager, but that transition often fails. Why is that?
So I think there's a few things, and I don't think it's one size fits all. Remember, different organizations may value slightly different things. In the end, hopefully all organizations that are capitalist in nature value production. They value delivering your P&L. I think that second piece is part of the challenge of becoming a manager, is that you don't just have revenue production responsibilities, you also have expense management, right? So it does get a bit more complex then, because now you need to understand what the levers are that are driving the revenue production. Some people are ready for that, some are not. But almost all organizations are looking for both those. But some are very much individualistic. They have a model that is very pure, pay for play, et cetera. Others have that, and they have cultural aspects. It's very important that you do things within our culture, and therefore we're going to measure both and pay for both. And then there are some that are at such scale that the pay for play is a little bit less than pay for production, and it's more about the firm is what's delivering everything, and you are a cog in the machine. And they don't say it that way, but that's ostensibly what they are. And depending which organization you're in, right, the producer that is becoming a manager is going to have a very different ability to deliver. So there's definitely this element of understand your organization and understand what they value in a manager before you just say, I want to be a manager. So just start with that and line up, do you have it in you to be a manager in this organization? Or is the manager role something that actually is very different than being a player? I use sports analogies a lot, right? It's a big difference between being the best player on the soccer pitch or being the best forward in hockey, right? Versus being the coach. For some reason in our business, we think you can just go turn it on and off. It's just not true. So there needs to be a transition period. And generally, I think banking, it doesn't do it as well as sales and trading. I'll explain why, because I've lived in both worlds. I, by definition, in capital markets for much of my career, had a foot in both areas. In sales and trading, what tends to happen is a good salesman or woman becomes a sales manager of a small pod of a group. And then they'll be moved from that pod to maybe running sales for all of credit. And then if they're good at running sales for, let's say, investment grade credit, maybe then they expand to high yield and investment grade. So now it's all credit. Then they go from that. If they're really good at that, they've now, after 10 years, they've really given up being the lead salesperson. And now they're a manager of salespeople. And they're a great candidate then to maybe run all the fixed income sales. Banking doesn't tend to do it the same way, right? Oftentimes, right, you're a line banker and one day there's an opening for a group head and you go from basically being full-time production where your management was management of deal teams, but it wasn't managing the P&L of the group, and you're automatically the group head. Big jump. Many people fail at that. Right. And then the next step is if you're going to then have a head of banking, they often go from being the group head of one sector or one product to them being named head of the investment bank. And it is difficult because we don't have as many steps along the way where folks can actually get that experience. And I'd say one of my benefits, having grown up in capital markets, is it's an investment banking business that works like a markets business. Again, I was running convertible bond origination in my 30s, which made it easy for me to then grow into running equity capital markets, which then led from running that to running all of capital markets. So I got a bit more of that market structure where you start managing younger. And then the last piece is, I would just say, for many people, that transition from being the producer and owning your outcomes with the clients to being a manager is scary. And that's one of the reasons why it's not just like you have to learn how to be a manager. It's that which makes us valuable for the first parts of our career. Owning the client relationship or the product, delivering it, being told, like, if you do really well at your job, you win. As a manager, it's about everybody else, right? Your success is defined by whether the people that work for you do their job well, and you're imparting knowledge on them, you're giving them room. It's not just that people may not be good at it. They might be scared by it because that giving up the day-to-day time with the client or freeing up room from that, right, takes them from what they're used to a new area. And that concept in life, it's in lots of things we do. Businesses have to go through it, right? I have a great product. When do I start investing in the next product? So I have to jump from one curve of killing it on this one to the next one. It's not easy, right? Change isn't easy. And so I think a lot of people fall down in that change period where they go from being a really good producer to a manager that's just learning. And organizations have to support it. Some do and put a lot of training around it, and they understand that management is an acquired skill and you need to learn it. Others don't. And the ones that don't, I think, make it very challenging for the aspiring manager.
Yeah, your take's really interesting. I've spoken to a lot of leaders, but no one's put it like you have in terms of that, the capital markets way that you looked at it, where you take steps and each step progresses you a little bit in your skills and you're able to grow as a manager alongside that. So I love that. And that makes a lot of sense because, as you said, 12, 13 years of execution and then suddenly in at the deep end is extremely difficult to shift those skills. Makes it a lot tougher. How should someone in banking decide which path's right for them?
I don't think it's binary. Right? I really don't. I think there are prerequisites. And so again, going to a sports analogy, in sports, you can have a very average player who ultimately emerges as a great coach. Now, I played in Division I, never made it in the pros. I became an assistant coach, and then I moved from that to coach. That happens. That rarely happens in our industry, right? Because in order to get the respect of the producers that you need to manage, again, we're talking front office now, right? You have to have had excellence in your seat, right? It's okay. Maybe you were excellent as an ABS trader and you moved to run the desk, and then you got moved to another desk, and now you're running the bank. But people recognize that at a time you were the best there was. So that's important, right? And that's why so often the group head will be the person that in say a sector banking context will be the best producer, right? But in terms of as a junior banker, your aspiration should be, I want to be a great banker. The prerequisite to then having the option down the road of can I be more of a manager is be great at your job. If you're great at your job, you can then down the road decide, do I want to basically be a banker for my whole life, which is a great career and et cetera? Or do I want to deal with the administrative and management responsibilities that go to being a group head? I think the one thing that will certainly, derail a career is if, because you're focusing so much on what the end game might be, you lose track of what's right in front of you, which is be a great analyst. And then if you're be a great associate, be a great VP. Now, there are stops along the way that can create optionality, though. So I'd argue when everyone's got their head down and focused just on getting deals done, networking and finding opportunities to understand what other parts of the bank do, people adjacent to you, understanding products inside out if you're in coverage, if you're in product, understanding the adjacent products, understanding what the client bank, like that helps. Being on task forces, when there are task forces looking at various issues that face the institution, be involved. Because don't look at that as, okay, that takes me away from the time I need to do like getting a project, my actual work done. Look at it as an investment in yourself because it creates optionality. You're learning, you're getting exposed to other things, and you're meeting other people. Certainly, if given the opportunity to be a staffer, being a staffer, I think, is often a prerequisite to becoming a manager down the road. Very few people get to lead a business if along the way they didn't, when they were more junior, usually as a VP, have the opportunity to deal with the challenges of senior bankers are asking for this. I don't have enough resources. How do I match that? If you do it and you enjoy it and you're good at it, right? Maybe you're on a track that you should think about wanting to be a manager down the road and running a group. If you hate it, guess what? What a great lesson. You learned something that you'd be better off just being a demanding banker, doing your job, et cetera, and let somebody else be the business head, right? And so I do think that there's things along the way you can do to expose yourself to the responsibilities of management and administration that would be there. And again, I think the other piece, which you might be getting to if I don't bring it up, is the difference between being a leader and being a manager, right? To be a good manager in this business, you have to be both, right? There's no such thing as I can be a taskmaster and that makes me a good, that doesn't work, right? You have to have core values and understand leadership, and you have to learn the job of a manager because leadership is a little bit innate. You can learn it, but being a good leader is something where you create followership because of the way that you operate. Management is actually, it's a function, right? There are things that you can be a great leader, you have to learn how to manage them. And we shouldn't confuse them. To be really good, you got to be able to do both. And I think that is a part that is often lost on folks. They think I can be a great manager, but I'm not going to invest the time in providing that leadership so people want to follow me. Not good enough. And you can be a leader without being a manager. There are some great people, great mentors. They have amazing careers as bankers, but they don't really want to deal with the headache of making sure the P&L works. What's the expense ratio going to be? What are we spending on tech and ops? Great, don't do that. Be a great banker, be a great leader, let others do the management. So.
Yeah, I couldn't agree more with you that I think you can definitely be a leader without being a manager. And that's actually really valuable. And using your sports analogies, I'm a big soccer fan, and you look for the guys where they've got several leaders within the team, not just the one who's wearing the captain's armband. So definitely You can relate to that. And I like your point about try to enjoy the ride and focus on being the best at each level, but look for those opportunities to pick up managerial skills and test whether it's right for you. Again, makes a ton of sense. And I think you told me previously about how great organizations can identify leaders and managers. And I think you said at Lehman Brothers, you saw a really deliberate approach to developing future leaders and managers. What did you do differently at that point? Or what did you see?
Yeah, so I think they're two separate concepts that I saw both applied very well at Lehman. One was having a robust education program on both leadership and management. And there are times they came together, but the view was that you couldn't represent the firm if you didn't understand the cultural norms and the values. And so there was a lot of training on like, how do we make decisions? How do we do it the right way and in a way that's consistent, such that if the same issue came up in 5 different parts of the institution, they'd make the same decision in all 5, right? Because there was right and there was wrong, right, et cetera. And it was more than what's legally right or wrong. It was, right, it's consistent with the way we operate, which might be different at a different institution, right? And so that education created a common framework so that one could be a manager or a leader or just a producer. And if they move from one area to another, they wouldn't feel like a fish out of water. And that was, I think, very helpful. And then they layered on top of that management training that was about how do we manage in this context. And all of our MDs went through it. Obviously, our senior leadership did it first, and then the MDs did. And then there was a version of that for directors and VPs. So as you were growing up in the organization, you learned both how do we do things, right? And then what do we do, right? And that again allowed us to do 2 things. And again, this came up in a lot of our conversation. It gave us a skill set of being better managers because we learned like there are things you just have to be educated on. It's not like everyone grows up knowing exactly how do we do the promotion process, what do we look for in that, how do we find people leadership skills. The bank did all of that, but you also went through these cohorts with folks from other parts of the institution. So as you were doing it, you were being exposed to a network that would help you as you moved up the ranks, be able to navigate difficult challenges. So something comes up for a banker that's tied to the rates business. You know what? Maybe I don't know the head of rates. The person who went through that director training with me, who sits in rates, I should call them up and they'll help me navigate it. And so it served a dual purpose of creating a vibrant internal network that was lit up by a shared set of the how and the why and the what. And so I thought it was very well done. And again, it wasn't created at our organization. I think they did it, the then leadership team did a really good job of looking at other great firms and what made them great. And what they found was that they invested in their future leaders and gave them what I like to call the lattice, right? That you could climb to ultimately make sure the organization propelled themselves further. And so that was very helpful. That's one bucket. The second bucket, which you can tell me if you want me to get into, is the way that myself and my partner back when we were running capital markets together did this, and I've used it many times since, which is using task forces on issues to allow people to self-select that they have future management and leadership aspirations and skills. And if you want, I can go into that more if you like. So.
Yeah, no, definitely. I think the task forces is a really interesting way. So yeah, please, a bit more information there.
Yeah. So
how did you use those?
Well, yeah. So I first got exposed to it when a partner that I was asked to work with together and I were brought together in the early 2000s to form what was one of the first global capital markets businesses. I came from the ECM side. He came from debt capital markets. And we brought DCM, LevFin, and ECM together. And again, we were going through this at a time when basically within a 3-month period, my old firm, Morgan Stanley and Goldman, all went that direction, and ultimately everybody copied. And we had a lot of challenges that we were trying to think through. How far can we go? How much integration? Where should we share things? Where shouldn't we? What are the things that are common where we might be able to get some efficiencies? What aren't? And we knew we didn't have the answers. We had some presuppositions, but didn't have the answers. So we ended up setting up 7 or 8 task forces to look at various issues. And it was a cross section of folks from the different businesses, but also from our partners, legal, compliance, risk, treasury, et cetera. What we got out of it was an enormous amount of information. I wish we had AI then, because what took us months to compile probably would have gone a lot faster, but it teased out a lot. It teased out a lot about what we could accomplish, what probably was a bridge too far, but what we hadn't anticipated, and it was the first time I used it, and I've done it many times since, was that some people who raised their hands to be on these various task forces mailed it in. They did it because they thought it was the right thing to do, and others really leaned in. They loved the intellectual challenge of it. They used it to network. They used it to become smarter, and the firm benefited from that. Those individuals along the way, my partner and I decided we're going to tag them because these are future leaders, right? Some of them are VPs. Some of them were senior managing directors. But what they showed was a ability to navigate more than just their area of expertise. And that intellectual curiosity combined with execution skills, because to influence your colleagues and get to a consensus requires leadership skills. We didn't anticipate that. And that led to what became, who are our future leaders at DCM? Who's going to run LevFin? We set up a new group that we formed that was a solutions group. The leader self-identified, didn't know she was doing it, but did, right through that. And I've never lost sight of that. And so I've relied on that concept of, at times I'll make up a series of issues to have a task force on because it's the double-edged sword of you kind of get two things out of it. You get a good read of what the organization is capable of and where we might be able to go and what might be too far. But at the same time, you have people who emerge as potential leaders. The tangible stuff, the list of items, execution, those are great. Far better is finding those future leaders, because the lifeblood of an organization is its people, right? We do things, but what we do today is only one thing. Investing in who's going to run a business 5 years from now, the most valuable thing we can do.
Yeah, it's really interesting. I love that task force initiative, and it's super smart, and can understand. Yeah, we were just talking about how leaders get opportunities to show themselves, to improve their skills, to be ready for the next step, and this kind of ties it all together and gives you really good access to who could be those leaders. So
and task forces, I would say the task force is like a petri dish for what I'd argue is happens every day, but it's just harder to see it every day. So the analogy of the task force is the banker that just understands better than others how to get their partners in the room, talk about an issue, agree on the plan, and move forward and execute. Or the person in, say, debt capital markets who understands that the client's needs are beyond their own and brings in the convertible bond originator, brings in the person from ABS and says, I'm going to be selfless. I know that we're not going to make money on this in this situation in investment grade debt, but the bank's going to win. And my job is bigger than like that person. You want to give that person more, right? And the job of the organization is to track that and find them. What the task forces do is it gives a natural opportunity for that mindset to come to the fore. So it's doing what otherwise the organization should be doing anyway.
As a leader here at Outram, I'm going to steal that idea. So thank you.
There you go.
We'll put some more task forces in place. I guess we've just talked a lot about leadership, about being a producer, moving, managing. To put a bow on it, what should a VP or director, a lot of our audience are VP and directors and those aspiring leaders looking to take that important step. What should a VP or director listening do differently tomorrow, in your opinion?
Here's a tangible thing that comes out of what we just said. I think that is the moment in time when if you take an inventory, which would be the first thing I would do, what are the things that have gotten me here? And then ask the question, and hopefully your organization is providing this for you, what does it take to become a managing director? That's ostensibly the goal that a VP and a director should have, which is, how do I get to the point where I am a partner or an MD, right? And usually that move forward is that you go from being able to execute to you can run teams that are executing. And then the next step is you can start winning business and you can start delivering the organization. And so the first is asking, what is the firm going to measure? And all those things are tangible. The intangible is, but how do you do it, right? How do I go from this? One is I got to relieve myself from being so involved in the execution that I don't ever free myself up for growing and taking on client responsibility, et cetera. So that's the first thing, which is once you figure that out, right? How do I make sure my associates are performing and giving me the leverage I need, and that they're doing that with the analysts? Are there things I need to change? Are there ways I have to communicate differently? Look at yourself. Like, what can I do? Then there's issues of how can the organization help you? Maybe you need to get better at navigating the organization in order to get better partnership with all the various groups you work with. Because the people that work under you are just one leg of the stool, right? The other legs are all the support areas, again, whether it be legal, whether it be compliance, whether it be your tech team, and are you being prioritized? And those are things where, quite honestly, sometimes for the senior managing directors, the group heads, they're beyond that. Like, they're not in the weeds. You're the one working with the VP and the other groups who can help you. Great opportunity there, because if you can get that leverage from those other areas, or from the product groups to support you, you're going to be more effective as a director. And then as an MD, they're gonna grow with you and they're gonna want to support you. So I'd argue starting to do a 360 of the areas of influence, not the things you control, but the areas of influence is really helpful. And I've always looked at that. And then the other thing is the things you can't influence, you have no control over, do not let them bother you. I think, and that is one of the most important things I share with my leaders, I share with my teams. Long ago, when I first became a leader, I read the 7 Habits of Highly Effective People, and I've never stopped using it because by the way, what I just said in the last minute all comes from that, which is there's the things you control, there's the things you influence, and there's things you don't. Do not spend any energy in the things you don't influence because it's just debilitating. Focus on those that you control and those that you can have some influence on. That's where the juice is. That's where the opportunity is.
Yeah, that resonates a lot. I'm a big fan of the book. I've read that, and the circle of influence, right? Isn't that the big part of that? And actually, the message to the Outram team this quarter, when we started it back in March, was to focus on what you can control. So I'm very much.
But that's where my comment before about also do your core job first before you worry about other things, because it goes to the concept of you can't be interdependent until you're independent. And you can't be a good partner to someone if you don't have the basics of your job down. So stop complaining about other people, what they need to do. Become unbelievably competent in what you do. You then have the ability to be a great partner and look for other people that can partner with you because you have your skills, they have theirs, and together the sum of the parts is better. The whole is better than the sum of the parts.
Great advice. I'm sure a lot of these aspiring leaders will definitely take a lot of notes there, and if they can start to
go read the 7 Habits. Stephen Covey. And now you can actually probably get a abridged version and get a lot of it.
So I'd love to talk a bit about strategy, crisis, and reinvention now, Larry. You stepped into the Chief Strategy Officer role before it really existed in investment banking. So what did you see that others didn't at that time?
I wish I could say it was prescient or whatever. It was really more reactive. So I was asked to take that role on about somewhere around 3.5 years into the integration of Barclays and Lehman. And to be fair, it was Lehman's North American operations that got acquired through the crisis. And what at the time, Bob Diamond, who was our CEO, and then the 2 co-CEOs of what was Barclays Capital, what they were trying to do was ostensibly do the back-end merger of Lehman and Barclays. I think what they had realized was up to that point, we had some areas that overlapped, but we really were basically a combination of the strengths of Lehman and the strengths of Barclays. The credit business was run by almost all former Lehman folks. Same with equities, same with investment banking. Yet FX and rates and commodities, et cetera, were basically run by all ex-Barclays folks. And the idea was in each business, we had co-populations, but we were never going to unlock the firm wholly if we didn't pull it together as one organization. And because I'd been lucky enough to be running global capital markets, first when I was at Lehman, but then they asked me to do that as Barclays as well, in that role, you're touching all the aforementioned groups, right, by definition. And so I guess by process of elimination, someone smarter than I noticed that and said, hey, Larry, we'd really like you to play a role where we move from being an amalgamation of business lines to what the future of Barclays needs to be. And they asked me to take on this role that was ostensibly an extension of the co-CEOs of Barclays Capital. And it turned out that what we really isolated was it was to focus on culture. It was to focus on things like HR and making sure that we have one value proposition for our people. It was to do strategy. It was to, in some respects, I think we ultimately defined it as if the job of the office of the CEO is to focus on delivering the numbers right now, but at the same time be focusing on where are we going 18, 24 months out. Larry, you own the 18 and 24 months out and make sure that what we come up with actually is doable for the business, that we can deliver against that. And the CEOs owned the delivery, right? The near term. And so that's what I took on. And so we tried to figure out what should that be. And they didn't have any title for it. They were like, whatever, Graham Poobah, we'll figure it out. And so what I did was I did talk to folks, and I ultimately I guess today I would have used ChatGPT or something, but back then I just used Google and I looked for people with similar roles. And the only place that at the time you could find that kind of a function where it was someone who came from the business, who was there to basically apply the business rationale to what should the strategy be, the execution, make sure it's realistic. The analog was what goes on in tech. And in many of the large tech companies at the time, they had these chief strategy officer roles. They tended to come from line managers, were moved in for a period of time and helped to make sure we recalibrated around their same path. And so that's what we ended up picking. So it was cross elimination. And subsequently, a lot of other firms have followed. But it was fun to try and define that role at the time. So
really interesting, and it must have given you your perspective and trying to understand how everything fits together more than the strategy around it. So must have been a really interesting time for you. And having been through different integrations, I guess two very different integrations, as you mentioned, Barclays and Lehman Brothers, and then TD Securities more recently in Cowen. What separates successful integrations from failed ones, from what you've seen?
I'd like to think that so far I've only lived at successful ones. I feel great about where we are in the integration of TD and Cowen. And looking back, I feel really good about what the combination of Barclays and Lehman did. Quite honestly, you wouldn't be thinking of Barclays today as one of the leading global universal banks, let alone wholesale banks, if it weren't for Lehman. Barclays would never have gotten there on their own. I think what I would say in both cases, one of the through lines in both, is that the leadership of the bank was committed to doing what was best for the bank and not what was best for individuals. And I don't think that's very easy. And without calling out names, I would say the leadership of Barclays at the time that they acquired Lehman, that was a pretty bold decision. Right? They stepped into the bankruptcy court, originally trying to buy the whole institution, ultimately got the North American operations. But once we came together, and it was a shotgun, it's not like other mergers, because it's the only time, I think, in the history of the US bankruptcy court that, because of the impact of the economy that Lehman shutting down would have created, they literally cut off the process quick and basically said, it's going to Barclays. And therefore, we didn't go through the normal merger integration. On a Friday night, it was decided that we were being bought by Barclays. We opened up on Monday morning as part of Barclays. Wow. If you contrast that to a normal deal, if you look at the Credit Suisse UBS merger, you look at the TD buying Cowen, which Cowen's pretty small, so it was really digestible. We were still merging entities a year and a half later, operating as separate broker-dealers. Here it was, you're shut down as Lehman and you're opening up as Barclays. And so we were together immediately. But the through line between both that I think proves to be really important if you're going to win is, and I mentioned this a bit earlier when I said the leadership of credit came from Lehman, the leadership of equities from Lehman, the leadership of rates from Barclays back in that story. It was a leadership team that said, we're not going to take the people that came with us and put them in charge just because they're my lieutenants. If they're not as good as the lieutenants that are coming over from the other firm, we owe it to our shareholders to pick the best. We have to win. And that was true at both organizations. If you look now at TD in the leadership, we have a leadership team where it's almost indistinguishable. You forget who came from Cowen or who came from TD. But what it wasn't, okay, the people from TD win because they have the TD jersey. Cowen people, you need to kiss the ring, or vice versa. And that was exactly the same thing at Lehman with Barclays. And I think it's why when you look forward, and notwithstanding the ups and the downs, and Barclays went through a lot of issues relative to the aftermath of the LIBOR scandal, et cetera. But if you look at it, they bought their ticket to being in the elite world of investment banking, universal banking, because of the Lehman deal. And because when you look inside the DNA there, it's a combination of two firms, a good combination. I think that's an important element, right? You take the best of both, and you hopefully don't get the worst of both, right? Because again, there's four boxes, right? Yeah. If you take two firms, you have things one does well, one does poor, vice versa. You could end up in good and bad. You could end up in bad, good. You want the good, right? You want to get the best of both. And I think in both places, I've seen executive teams that have really worked for, let's take the best of both and discard of the things we're not that good at.
Amazing. It's so interesting, and to have been through it twice, like the wealth of knowledge you have.
Yeah, I'm not looking for a third. I'm not looking for a third, Pete.
Let's speak again in 10 years. Please.
Please.
Believe it or not, we're coming towards the end of the episode, but I guess a couple of questions to finish. You've had a 25 plus year career across multiple institutions, cycled roles, as we've discussed. What separates the people who compound over decades from those who plateau, Larry?
I'm going to throw in a third group, because I think there's those who plateau, there's those who compound. within the industry. And then there's those who compound, but they leave the industry and do great things as well. And I want to throw, so I think that's a very viable path, in particular, if our target audience are VPs, directors, young MDs. Any three of those paths are still ahead of them, right? So I think let's just rule out those who plateau. I think the plateau tends to come from lack of growth. And I think one can expect the organization to provide growth paths, but that's very passive, right? I think in order to have a vibrant career, particularly today's day and age, maybe 35 years ago was slightly different and there could be more trust in the system. I think that trust has been burned for so many reasons in terms of the way the world works. And I think that you have to look at yourself as you're a partner with the organization that you work with on your career. But in that partnership, you have to own the 51% vote, not the firm. Right. And so you need to own your networking, you need to own your investment in your skill set, et cetera. I think if you don't, then you lead to plateauing, because only you know whether you're still being challenged. Only you know if it's time for, maybe I should move groups. Maybe I should raise my hand, take on a new responsibility. Maybe within a group, I should be moved from certain clients to other ones because I'm just not getting the learning that I should. And the firm maybe doesn't notice it. You know that you're missing whatever it is. I haven't done enough M&A deals. I haven't done enough LBOs. I haven't done enough, whatever it is. Own your career. So I think that's the first thing. I think when you get to the second stage, so then you get to, okay, what distinguishes those who haven't plateaued? You referenced earlier that one of the other people you interviewed talked about variety was a key to preparing them. I really do think that's a big element to it. I think that even when you're great at something, it gets boring to do the same thing over and over. And so making sure that you have enough continued growth, that you don't get so comfortable in what you're doing that you don't grow. Because the problem is, all of a sudden the world changes and what you were doing isn't in favor anymore. And if you're not versatile and you're not a problem solver because you haven't seen enough, you become expendable and or you atrophy. And either one leads to that plateau you were talking about. But if you're always growing, always inquisitive, and you've acquired a broad skill set, right, you can roll either way. You can move at the punches, so to speak. And I think that's what distinguishes those who either continue to grow into more important roles in the organization or things open up to them. Right? So many of the people that moved on and are maybe running hedge funds, maybe running private equity funds, maybe the CEO or CFO of what was clients at one point, that they were open in all those cases, whether it be internal or external, to a new challenge, a new opportunity, and they felt confident enough in themselves because they had built in some of that versatility that they could take it on. So I think that's an important element, right? Don't be so narrow.
Yeah, and I couldn't agree more. Being really intentional about that growth and caring and looking for the opportunity available, building the variety. I guess it's sharpening the saw, isn't that the 7 habits? Is that
sharpening the saw?
Right?
Yeah, going back to exactly right. Exactly, sharpening the saw.
So I think there's a lot in there, and I guess with AI as well, it's really easy to sign some of that away. You've got to be way more intentional, I would imagine, than before. So
yeah, listen, that is the big risk of AI. There's a lot of big risks, but I think in terms of creating future leaders, the issue is for everyone that you've interviewed, I'm sure, and really anyone I talk to who's at a point in their career where they can look back and say, okay, how did I achieve this? It starts by knowing the building blocks, right? And we talked earlier about you've got to be really good at something in order to get the right to then be good at multiple things. And the worry is that if you rely too much on tools and you don't understand how it works yourself, that you're going to be only an inch deep. That's not good. You have to really understand it, because ultimately it will come out. If you don't really understand, for example, how the DCF works, right? You can't be an expert in value, right? You can't be an advisor on things if you don't understand the accounting inside out. There's building blocks. You need to understand accounting. You need to understand finance. You need to understand valuation. You need to understand negotiations, et cetera. I would definitely argue people need to use AI as a leveraging tool, but not as a replacement for doing the hard work and doing the hard yards. So
amen to that. Look, Larry, as I said, it's been a phenomenal episode. Final question. Exciting times for TD. We spoke about that at the top of the interview. What's ahead for you and the firm?
Look, I think, thank you for asking that. We've had a really good run in the first 3 years of our integration. The best way to think of it is, because I did reference this earlier, bringing two businesses together in the regulatory environment we live in takes time. There's no panacea. There's no way to go faster. You need to get the regulatory approval. Before you get the regulatory approvals, you need to make sure you're comfortable with the control environment. the tech working. And so the first year and a half in an integration is really very inward looking, because you can't begin to get the 1 + 1 = 2 or more than 2 till you actually bring it together. And a lot of that work was behind us basically by somewhere like we'll call it middle of 2024. And so we've been able to, for the last 2 years, focus on delivering for clients. And so what's been exciting is that we had a view and a belief that there was a lot of our existing clients that we had real trust with, but because we didn't have the full services, either at Cowen or at TD before that if we could just deliver for those clients across more, they'd reward us with more business. And we've seen that. And we're now able to have clients that can pay us in 5 areas versus in 2. That's great. That's exciting. What's even more exciting, though, is we're now attracting new talent on the platform because we have a lot of white space. Because the Cowen business plan didn't include being all things to all people, and TD Securities, certainly in the US, wasn't that, because they didn't have the equity business, the built-out M&A business, full-service investment banking. We're filling in gaps. And we're finding people are leaving organizations where maybe they're 1, 2, or 3 in their business, but there's a different excitement about building than there is about making sure you don't lose market share that somebody else built. And so we're bringing great people who want to be a part of a build. And so I think what you'll see, to your question, over the next few years is us starting to fulfill our vision of really becoming one of the most important wholesale banks in North America. Because as we build out the greater product set, build out the broader services, we can deliver more, both for existing and for future clients. So it's an exciting time, really exciting. And so looking forward to that.
Amazing. No, super exciting. I can see how that growth vision's coming together, and I'm sure it's going to be very successful. And we look forward to helping you celebrate those deals when you're ready, obviously, as your
you got it. Exactly right.
As your partner on that side.
Let's get the plug in for you guys too.
Why not? Yeah. Hey, Larry, thanks for your time. It's been an incredible conversation. It's a real masterclass on how to navigate IB beyond just execution. So thank you for sharing all the insights. Thanks for sparing us the time. It's been great speaking with you.
Appreciate it. Thank you for the time. Thank you for doing these. It's very helpful. And I speak, I think, for the aspiring bankers who tend to be the ones listening to this. What you do is very helpful to them. So thank you for doing it.
Thanks, Larry. Appreciate that. This episode of the podcast was brought to you by the Investment Banking Leaders Club. And to keep leveling up your career, join the club at ibleadersclub.com for exclusive insights, leadership strategies, and career growth resources straight from the industry's top professionals. I want to say thanks to our key partner, Outram, the global leader in financial deal gifts, awards, and recognition, for their ongoing support of our mission to empower both aspiring and senior investment banking leaders. I really hope you enjoyed today's episode. Thanks for tuning in. And until next time, best of luck on your growth journey.